Good day, all stock market traders and investors. This is Total Investor, and on this YouTube investment channel, we look for trading opportunities and just basically ways to make money in stocks and commodities. Now, today, I'm going to do something a little different. We're going to be talking about Dogs of the Dow investment strategy, specifically for 2024. Now, you may have heard about this, or may not. It's a few years old, but I think that it's well worth looking into. Now, it does not have anything to do with cute dogs. It is basically an investment strategy. Okay, now, if you are interested in something new that can make you money with investments, I think, stick through this entire video and learn something new. Please keep in mind, you should be subscribed to this channel. If you have any desire to learn about investments, subscribe to this channel and YouTube will notify you when a new video is posted. Okay, all you got to do is hit the subscribe button. Okay, so let's get started with Dogs of the Dow investment strategy. First of all, what is it? Introduction to Dogs of the Dow. The Dogs of the Dow is an investment strategy that has gained popularity among investors seeking a simple yet potentially profitable approach. The strategy revolves around selecting a portfolio of high dividend yielding stocks from the Dow Jones Industrial Average. Okay, the concept dates back to the early 1990s and has since garnered attention for its straightforward nature and historical performance. Okay, I'm going to talk to you more about this strategy. The Dogs of the Dow strategy was created by Michael B. O'Higgins back in 1991. He noticed that the dogs of the stock market, basically the stocks with the highest dividend yields, tended to outperform the rest of the stocks over the long run. Okay, and here is proof. In green, now we've got like several heading, and this is for, let me see, since 2000. Okay, so we've got like almost 20 years of, more than 20 years of data going here. First, the green one is the Dogs of the Dow, which is what we are going to show you how to find them. Dogs of Dow. The light green one is the Small Dogs of the Dow, which is a sort of a version of Dogs of the Dow. Red, Dogs of Dow X. Pink, Small Dogs of the Dow X. And the last four are basically the stock markets as a whole. We've got gray, which is the S&P 500. Lighter gray, Dow Jones Industrial Average, slightly higher. Blue, it would be Fidelity Magellan. And finally, Vanguard Index 500. Okay, so the last four are basically indexes of stocks in general. And the first four are basically versions of Dogs of the Dow. Okay, so they are outperforming the general market, not by a whole lot, but over many, many, many years, it does make a difference over time. Okay, so now according to Michael Higgins, who found this method, following the method from 1973 to June of 91. Okay, so we're talking like almost 20 years. This is going back a while here. You would have made a cumulative profit of 1,753% compared to the Dow itself returning 559%. Okay, and that doesn't include commissions or taxes. That is huge. 18 years. Look at the difference. More than 17 times versus 5 times your money. Okay, that is a huge difference with the Dow, Dogs of the Dow. That's 16.61% annually for the dogs and 10.4% for the regular Dow stocks. Okay, so 10 stocks versus 30 stocks. The dog rules. Okay, so here are the rules for the setup. One, at the end of each year, or really any year that you can choose, although it's almost always done at the beginning of the year to the end of the year, you would rank the stocks in the Dow Jones Industrial Average according to the yield. Okay. Two, You select the 10 stocks with the highest yield. Now, usually there is no tie in terms of yield, but if there is, then you would select the stock with the lowest price. Okay. 3, you would buy an equal dollar amount for each stock. So if you had a portfolio of, say, $100,000, it's $10,000 for each stock. Okay. And finally, you would hold each of those stocks for the full year, meaning the end of December of the same year, and then you would sell them and then start the whole process over on January the 1st or the 2nd. Okay, whatever the first trading day of the new year would be. Okay, the small dogs of the Dow is just a similar version of the dogs of the Dow. At the end of the year, you would rank the stocks of the Dow Jones again by dividend yield. You select the 10 with the highest yield, so that gives you the dogs of the Dow. From the 10 with the highest yielding stocks, you select the 5 with the lowest stock price. Okay, you buy an equal amount. Again, if you have a $100,000 portfolio, because there's only 5, you would take $20,000 in each of those 5 stocks. You hold the stocks for the full year, and then at the end of December, the last trading day, you sell it, and of course you would buy them back again, repeating the process on the first trading day of January. Okay, now it's not perfect. Again, no strategy is. In fact, it didn't seem to work quite as well last year. The 2023 returns for dogs of the Dow versus the Dow Jones Industrials. The dogs of the Dow, 10 stocks with the highest yield, gave us 10.1% for all of 2023. The Dow Jones Industrial Average of the 30 stocks returned 14.4%. Okay, so again, that's 1 year only. We want to look at the longer term and see how that goes. Well, here are the stocks, the 10 stocks with the highest yield in the Dow Jones Industrial Average as of the last trading day on December 2023. Okay, and I'll read them out to you. It's Walgreens. It had the highest yield, 7.35%. Stock symbol for Walgreens, WBA, Verizon, VZ, Cisco, CSCO, the Dow, or Dow Chemical, it used to be Dow Chemical, DOW, Coca-Cola, KO, 3M, MMM, Chevron, CVX, Johnson & Johnson, J&J, IBM, which is IBM, and Amgen, AMGN. Okay, so we've got the stock price, what it was as of the end of last year. Some of these are a little bit lower, not much, but that's just because, we had a little bit of a sell-off early on the first week of January. So you're actually getting in at a lower price than those who got in on the first trading day of January. So that's good. And here we have the yield for each and every one. If you were going to do the entire dogs of the Dow, you would buy 10,000 in each of these stocks, okay, and that'll come out to $100,000. If you were going to do the small dog of the Dow, what you would do is you would just buy the lowest price ones in this particular chart. Now, I've already put them in order of the lowest price to the highest price, so it's basically the first 5. So Walgreens, Verizon, Cisco, Dow, and Coca-Cola are the small dogs of the Dow. Okay. Now, obviously, there are questions that arise from here, and that is the dogs of Dow strategy suitable for all investors? Fair question. The dogs of Dow strategy may appeal to investors seeking a straightforward approach to investing in blue chip stocks with high dividend yields. However, it is important to note that no investment strategy is without risks. Okay, it is recommended that investors carefully consider their financial goals, risk tolerance, and conduct a thorough research before implementing this strategy, or really any strategy. Okay. A second question would be, how often should the dogs of the Dow portfolio be rebalanced? Okay, most will say, well, it could be every quarter, every half year. Well, this one really isn't done so quarterly. It's this particular portfolio should be ideally be done annually, okay, because you're holding on from the beginning to the end, typically from the beginning of each calendar year. Rebalancing involves selling stocks that are no longer part of the highest dividend yielding stocks in the Dow Jones Industrial Average and replacing them with the new dogs of the Dow for the year. Okay, so sell them at the end of the year, buy them at the beginning of the year, a new 10 or a new 5. However, investors may choose to adjust the rebalancing time frame based on their individual preferences and market conditions. Okay, again, keep in mind that it is actually once a year, although you may choose otherwise. Okay, and finally, 3, a final question that needs to be asked: what are the potential risks associated with the dogs of the Dow strategy? Well, the dogs of the Dow strategy can offer attractive dividend income and the potential for capital appreciation. There are risks to consider. Market volatility and downturns can impact the performance, and sector concentration risks may arise due to limited diversification within the portfolio. Again, keep in mind that you only have 5 stocks or 10 stocks. Okay, so that's why you don't have the amount of diversification. Furthermore, changes in dividend payments or cuts by selected company can affect overall returns. Companies may start off with paying, 6-7%, but that dividend may end up being cut, and you end up, missing out here. It is crucial for investors to be aware of and manage these risks accordingly. Okay, so basically that is the investment strategy called Dogs of the Dow, and of course a version called the Small Dogs of the Dow. You can do more and more research out there if you wish. It has done very well over time, and that's the way you really have to see it. These are pretty much safer stocks because they are listed in the Dow Jones Industrial Average, and it's pretty much straightforward. It's simple. You don't have to watch it every day. It's basically buy it and leave it for a full year. Okay, now if you think that this is something that you should pursue, want to do your own due diligence, do more research on the internet. Information is out there. I'd love to hear what you have to say about this. So any comments down below, please give it a big thumbs up. And of course, subscribe to this channel for more investment advice or information, whatever it is that you can make money on. I'm there for you. Let me know what you want to hear, whether it's stocks, commodities, crypto, you name it. I'll try to, make a video out there for you. So having said that, I will see you in the next video. Take care.